There are 3 stages in your relationship with money. Stage 1, you worry about money because you don't have enough. Stage 2, you stop worrying because you have more than enough. And Stage 3, you start to worry again because you have so much money it's becoming a problem and managing everything is a full-time job. This video is about the 3rd scenario. Somewhere past the $100 million mark, you're no longer a wealthy person. You're more of an institution. Money is now referred to as capital. That's when the spreadsheets become staff. And in the world of the rich, the staff is called a family office. And this is how they operate. Welcome to Alux, the place where future billionaires come to get inspired. So any person with a basic financial understanding can manage $1 million. You put some of it into a safe stock fund that grows over time, a bit into bonds that pay you some steady money, some into real estate so you own a building or land, and keep a little cash in the bank for emergencies. You can essentially do everything from your phone and just live off the money it makes, comfortably for the rest of your life. But what happens when you have $1 billion? Because look, okay, a bit of $1 billion still means literally hundreds of millions of dollars. At that level, you're earning millions in interest per month. You might own multiple businesses, properties in different countries, art collections, complex equity positions, and legacy obligations. Even your charity work becomes a logistical beast, requiring lawyers and accountants just to give money away. Wealth, when it reaches this scale, behaves more like a corporation than a bank account. Most people only deal with professionals like lawyers or investment managers a handful of times in their life, if ever. Maybe a lawyer for a will, a banker for a mortgage, or an advisor when retirement is near. But for the ultra-wealthy, those needs are constant. Legal questions come up weekly. Big financial decisions happen daily. Managing assets, taxes, investments, and even reputations requires a full-time team. So instead of hiring people one by one for every problem, it's just easier to bring them all in-house. You hire your own lawyer, your own banker, your own tax strategist, put them on a payroll, and make their full-time job managing your wealth. That's essentially what a family office is. If you are Batman, the family office is Alfred. And these are the kinds of insights not everybody gets access to, but you'll get the inside scoop on all of this and more within the Alux app. It's not cheap because we've literally paid millions of dollars to the smartest people in the world, and you can get access to all of it for only $1.99 a year. Hundreds of thousands of CEOs, founders, creators, business owners, and anyone with the entrepreneurial grit to make something of themselves are just proof of how valuable this app is. So go to Alux.app right now and download it. After you've got it on your phone, since you're a subscriber to our YouTube channel, scan this QR code on screen right now and you'll get 25% off the yearly plan as a thank you from us to you. But let's get back to today's discussion, shall we? Okay, so there are more family offices now than ever before, and they're managing trillions of dollars. The rise of tech billionaires and crypto millionaires created a new wave of first-generation wealth, and with it, a need for customized infrastructure. Traditional banks weren't built for 29-year-olds with $400 million practically overnight. That's where family offices came in, offering speed, discretion, and tailored control. As of 2023, estimates suggest there are over 12,000 family offices globally, with more than 7,000 based in the US alone. That number has doubled in the last decade. According to research by UBS and Campton Wealth, the average family office manages around $1.2 billion in assets, but some, like the Walton families or Bezoses, oversee tens of billions. Now, collectively, family offices are estimated to control between $6 and $10 trillion in global wealth. And a massive generational wealth transfer is underway. Over the next 20 years, more than $84 trillion will pass from baby boomers to Gen X and millennials, and that money needs managing. At that level, private banks and wealth managers just aren't enough anymore. You need a full team, tailored to you, working only for you. This surge in demand has even created a family office arms race, with ultra-wealthy individuals competing to hire the best talent, poaching lawyers, investment analysts, even PR experts from top firms to build up their own private teams. And because they handle everything in-house, family offices develop their own proprietary investment data and insights, giving them an edge over even elite hedge funds or traditional advisors. So, why exactly are these family offices so sought after? Well, when you hit the $100 million plus mark, your financial life gets exponentially more complex, not linearly. We're not talking about moving from 1 to 2 homes. We're talking about 30-plus legal entities across multiple countries, 5+ asset classes like stocks, private equity, real estate, etc., 3+ generations with inheritance plans, personal assets like yachts, jets, you name it, as well as staff from security, assistants, pilots, the list goes on. Now, imagine trying to pay taxes in 3 different countries, track ROI across dozens of investment vehicles, plan for inheritance for 3 kids without them fighting, shielding your assets from lawsuits or divorces. I mean, it's a full-time job for multiple people. And according to Campton Wealth's Global Family Office report, the average family office employs about 14 full-time staff. And that's for millionaires, not even for billionaires. Now compare that to Bezos Expeditions, Jeff Bezos' personal family office. It reportedly employs around 159 professionals, from lawyers and analysts to philanthropic strategists and venture scouts. To put that into perspective, that's more advisors than most kings had running their entire courts, and their sole job is not to run a kingdom, but to manage one man's fortune. In 2019, Jeff Bezos finalized the most expensive divorce in modern history. His ex-wife, Mackenzie Scott, walked away with 25% of the Amazon shares the couple jointly held, worth around $36 billion at the time. Now, most people saw the headlines about the size of the payout, right? But what went unnoticed was how clean and frictionless the entire financial transition appeared. There were no drawn-out court battles, no messy disclosures, no massive tax events. And that's because the structure was already in place. The family office handled the transition behind the scenes. It coordinated asset transfers, updated trust structures, and managed risk exposure while keeping Bezos' long-term financial blueprint intact. The office, it didn't react to the divorce. It absorbed it. His control over Amazon remained stable, his wealth continued compounding, and most importantly, the legal and tax implications were minimized through pre-arranged strategies crafted years in advance. In high-profile divorces, brand value can definitely take a hit, but Bezos' public image and Amazon's market confidence barely even wobbled. And that's coordinated behind-the-scenes damage control executed by a family office with a crisis protocol. So, after saying all of that, when should you consider a family office? Well, let's just say you sold your tech company. After taxes, you walk away with $500 million. Congratulations, my friend, you are rich, but now the real work begins. First, your money lands in a private bank. Once you've got more than $1 million in investable assets, the system officially tags you as a high net worth individual. And that label upgrades your banking experience. No more call centers, you're now assigned a relationship manager and you get access to private banking divisions. It's a VIP treatment, but in the wealth world, you're still at the entry level. Cross $30 million in assets and you become ultra high net worth. Now, along with the title, that sounds kinda like a Dragon Ball Z power level, you unlock access to more elite financial tools, hedge funds, private equity, and co-investment opportunities. Banks might even offer global family office services, pre-built teams that manage multiple wealthy clients. It's not a personal family office yet, but it's a preview of what's to come. But only once you pass the $100 million mark do you enter a different league. Now, some banks assign full-time, white-glove teams whose only job is to serve you. But by then, you might be asking a different kind of question altogether. Why am I still using the bank's people when I could just hire my own? The bank exists to make a profit, so their advice will always carry some kind of bias. Your lawyer says you need an estate plan, your accountant warns you about exposure to different tax jurisdictions, your spouse wants to buy a vineyard in Italy. Each problem spawns 5 more. You're dealing with private bankers, fund managers, lawyers, and nobody's talking to each other. It's a bit chaotic, right? And that is when a family office becomes a viable option, a good choice. And this is how you set it up. So, you form a limited liability company, and you name it after your favorite mountain. Naming it after a favorite mountain or childhood street might sound kind of poetic, but it also makes it pretty hard to Google. You base it in a place that offers favorable tax laws and privacy. Some go with Delaware in the US for its flexible corporate laws and anonymity. Others prefer Singapore, Switzerland, or Dubai, places known for financial privacy, tax efficiency, and investor-friendly regulation. And this becomes your family office. It's just the headquarters. The team might be remote. Then you start to hire, and usually the order is as follows. Money first, then safety, then growth, then logistics. Your first hire is almost always someone who used to manage wealth like yours, but for somebody else. Usually a former private banker from a top institution. You offer them better pay and total control. They track every dollar, reduce exposure, and keep you from making expensive mistakes. They consolidate your balance sheet, cash, stocks, real estate, startup equity, art, crypto, yachts, all of it. This person becomes your chief financial officer. Next, the CFO brings in a lawyer, usually specialized in generational wealth. You want someone who eats up trust laws for breakfast, the kind who can set up multi-generational vehicles that survive lawsuits, divorces, or unexpected deaths. They draft your trust documents, create additional holding entities, and firewall your assets. Then comes the tax specialist, ideally a former IRS insider or someone who worked for the Big Four. They know the loopholes, the treaties, and the lines you shouldn't cross. They design a tax map that minimizes your burden without ever triggering the wrong kind of attention. At this point, your money is secured, but it's not growing. So you bring in someone with deep access to private deals, hedge funds, and off-market real estate, a chief investment officer. This person will oversee all investments from private equity and hedge funds to real estate and venture capital. And lastly, you hire for logistics. You might need a family office manager, a philanthropy director, or a lifestyle concierge. In Silicon Valley, some family offices hire life coaches or mindfulness consultants for their clients' children to help them grow up balanced in a world of access. The Gates family office has a dedicated philanthropy infrastructure. Every dollar gifted is a part of a long-term impact strategy. Some hire former diplomats to help with international travel or relocation planning. Others bring in art curators to manage collections worth millions. Private equity, hedge funds, offshore banking, trusts, they all orbit around one thing: the family office. This is the final control tower of generational wealth. These are the foundational financial systems the rich use to preserve and secure their wealth. The somewhat easy ones to understand. There are a lot more, okay? Some create private insurance companies and they insure themselves through themselves and keep the unused premiums as profit. Some create think tanks to shape laws in their favor by blocking taxes and regulations. And maybe we'll talk about those later on. Until then, thanks for watching, my friend. We'll see you back here next time. Take care.